I want to share with you some information about Chapter 4. This will add to the demonstration videos that are in the chapter already in Blackboard. But I want to put both desired saving and desired investment together in the goods market. So what we've got here is the goods market. Our second market after the labor market in the production function as well. And in the goods market, as you've already seen, we have the real interest rate on the vertical axis. We have the, sorry about that. We have the level of investment and saving measured on the horizontal axis. We have desired investment, downward sloping curve, desired saving, an upward sloping curve, and where those lines meet, that's the equilibrium in this market. And here's the real interest rate in the equilibrium. Here's the level of investment and saving in equilibrium. Let's call it I0, S0. They're equal at that real interest rate. That's the point here. All right. So first of all, I want to talk about the curves themselves for just a moment. There's a separate demonstration video for each one of these curves. All right. And oops. Oh, come on. We lost our pen. All right. Got it back. All right. So each one of these curves represents decisions. And it's important for you to understand that and think about that. So these are consumers, right, making decisions here. And they're making decisions about consumption today versus consumption tomorrow. So anything that they're not consuming today is saving out of their income. So this desired saving curve is a representation of consumer behavior. There are people making decisions behind that. It's not just a graph that comes out of thin air. And they're making a decision about how much to consume today versus how much to consume tomorrow. And that's going to depend on the real interest rate. So the real interest rate, as the real interest rate rises, right, as we move up this curve from left to right, as the real interest rate rises, the return to the benefit of saving more today, so you have more consumption in the future because you get interest on the money that you don't spend today, putting it in the bank, you can think about it that way, right? As the return to saving money increases, you're going to tend to want to save more of it, or in other words, you're going to want to consume less today. So you decide the price of consuming today, the cost of consuming today, not in terms of the price on the sticker, but the actual opportunity cost, what you're giving up in future consumption increases if the real interest rate rises. So that's the substitution effect, right? It tends to cause you to want to save more as the return to saving increases. There's an income effect as well. As the real interest rate rises, you don't need to save as much to hit some target level of income. And that tends to reduce the amount that you want to save, actually. And so the question is, which one tends to dominate, the substitution or the income effect? And what our assumption is, theoretically, we don't know, right? It's not given, right? It's actually covered in the appendix to this chapter about with indifference curves and utility maximization. You would cover that in intermediate microeconomics. We don't need to cover that with indifference curves here in this class. But if that helps you, you can look in the appendix to chapter 4 as well. That has to do with this desired saving curve. What causes it to look the way it does and what causes it to shift. Right? But we can just think about the substitution income effect more generally. That's on 2 pages in the middle of the chapter in the book, okay, in the textbook. And then the second question is, what causes, for a given real interest rate, what causes consumers to want to either consume more today? That's a shift, in other words, save less today. That would be a leftward shift in the desired saving curve, right? Or to want to save more today, consume less today. So in the chapter, there are a variety of factors. I'll come back to that and actually point those out. Right? There are a variety of factors that lead to those shifts, right? And they're in a table in the chapter, summarized there in a table in the chapter, right? So things like an increase in expected future income will cause you to want to spend more today, consume more today, right? Therefore, save less out of current income. So that would be a leftward shift of the desired saving curve. All right. And then a change in wealth will cause you to want to either consume more today or less today, an increase or decrease in the stock market, for example. All right. Now, that is part of what's behind the S curve, the national saving. So this is national saving, right? So national saving is made up of private saving plus government saving. You need to go back to chapter 2, to the uses of saving identity, right? And you'll find there what are the things that affect government saving. So if the government spends more on transfer payments, if it spends more on government spending on roads and bridges, if it spends more on education or the military, right? That is going to reduce government saving and by itself reduce national saving. Right? The question is, what happens to private saving in that case, right? So it's important to understand that this saving curve is made up of two parts. The private saving part is the part that deals with decisions by consumers about whether to spend more today, consume more today, or less today. Government saving has to do with decisions by Congress and the president on how to spend and use the budget of the government. Right? Or tax more or tax less, right? So that's national saving. Desired investment, right? This downward sloping curve has to do with firms, right? In this case, whoops, again, we lost our pen. All right, come on. Has to do with firms, and they're deciding how much capital to purchase, new plant and equipment, industrial robots, warehouses, new factories, etc., in order to maximize profits. It's the analog to what we did in chapter 3 when the firm is trying to maximize profits with respect to hiring labor. Here they're buying capital, right? And they're going to compare marginal cost and the marginal benefit of getting one more unit of capital. Well, changing the amount of capital has to do with investment, right? Investment is not financial investment. It's not the stock market. It has to do with buying capital, right? Buying capital. And that's a profit maximizing decision by firms. So the real interest rate comes into play there. It's a downward sloping curve because the higher is the real interest rate, right? If we're up here, the high real interest rate, they're going to want to invest in less capital because the cost of getting that capital, right? Borrowing money, the cost of borrowing money to get capital is going to be higher, so they're going to do less of it. The lower is the real interest rate, the more desired investment there's going to be because it reduces the user cost of capital, right? That's the discussion in the chapter, and therefore, for any given level of future expected marginal productivity, again, it's the marginal productivity of capital, it's like the marginal product of labor, right? The lower is the real interest rate, the more profitable it becomes for to buy more capital, right? It's cheaper to buy more capital, right? And so they're going to be willing to go buy more capital to a point where the marginal product of capital in the future is equal to that lower level. So there's going to be more of it. Now, so that has to do with why the curves look the way they do. The next question then is what happens when something happens to shift one of the curves. Remember, in this course, the idea is you get some real world event, and the question is which market, which curve, which way, right? So if something happens to cause consumers, for example, to reduce their level of saving, right? So for a given level of interest, right, was here, now there's less saving, right? That's a leftward shift. Shifts are right and left in this market. So less desired saving, that's going to lead to an equilibrium, right? that is got a higher real interest rate and overall less saving and less investment, right? So that goes up, that goes down. So what are the kinds of things that could affect that? You need to go back into the chapter, think about this, look at the examples that are there. Every one of the sections talks about that, something that's going to affect that. It could be something that, so a reduction in saving is something that's going to increase consumer spending, right? So in this case, it could be increase in wealth, increase in the stock market, for example. It could be getting COVID checks. It could be getting some a new expected future income goes up for some reason. So those are things that would shift that curve. And what you can see is that has impacts on investment and the real interest rate. We can actually take this back to the uses of saving identity, where from chapter 2, and if you go back to that, or it could also be, this could also be, so this is either a reduction in private saving or a reduction in government saving. So a reduction in government saving means an increase in the budget deficit. So they're either reducing taxes or increasing spending, one of the two, right? So this is equal to I plus CA. In this chapter, we're assuming that the current account is 0. There's no trade deficit or surplus. It's a closed economy. In chapter 5, we're going to bring that in, right? And so this just kind of goes out of that equation for now. And what we're saying is if government saving goes down or private saving goes down, there's an equal sign here. So something on the right side of this equation has got to go down. What would you expect to happen in this case? If there's no current account, there's no trade with other countries, what's going to happen is investment's going to go down. We didn't have the theory to explain that back in chapter 2. We just knew from the uses of saving identity that that would happen, right? Because there's an equal sign there. It has to be the case. If something on the left goes down, something on the right's got to go down, right? To keep them equal. Well, now we can see what's going on, right? As private saving or government saving goes down, that's this leftward shift in the desired saving curve, which raises the interest rate, which then makes it more expensive to borrow, which leads to lower investment, which is a move along the desired investment curve. In other words, increased budget deficits could crowd out, right? That's what it's called, crowding out, because of causing higher interest rates, crowding out in desired investment in new capital, right? So now we have the theory to answer one of the questions on exam 1, for example, about the uses of saving identity and whether we should be concerned about budget deficits or not. Here's the theory that's behind that. So this is one example. But the general point here in this video that I'm trying to lay out for you is that once we understand where the curves come from, what causes them to shift, then we can actually go through examples where if there's a shift in the curve, what happens in that market to the real interest rate, what happens to investment and saving in the economy in that case, right? And so it's just, there are only 4 possibilities. Either desired saving will shift to the left or shift to the right, or desired investment shifts to the right or shifts to the left. And so it's useful to go through. This is just one of those 4 examples, but it's useful to go through each one and then to link that to what could have caused that in the real world. And in the chapter, you're actually given examples of what could cause that. So let's take a look at that for a moment. Let's go back and I'm going to show the textbook, right? And by the way, if you're not aware, right, you can create bookmarks, right, in your book down here, right, in the textbook, right? So you can come back to things. And let's just use the consumption and saving part for right now, right? So what are the things that affect consumption and saving? And if we go through each one of those subsections here, right, we can look at what are the changes, effects of changes in current income, or effective changes in expected future income, or changes in wealth, or changes in the real interest rate. The first 3 are things that shift the saving curve. right? The last one is a move along the curve, and it's why the curve has the shape that it does. The next one has to do with government saving, and that's fiscal policy, changes in taxes and government spending. That also affects the desired saving, national saving curve. Now, if we go down and look at the end of this section, there's a summary box, and it talks about each one of the previous sections, changes in current output or future output or wealth or expected real interest rate or government purchases or taxes. Those are all the different sections of the chapter in one table. And these are the things that, right, shift the curve. Or in the case of interest rates, it's a move along the curve. But every one of these, every other one of these is a shift in the curve. It's important to understand this. And there's another one of these tables, summary table 6, in the investment section in this chapter. So it's really important for this is really the cliff notes of the chapter to talk about what happens in equilibrium then, right? What causes a shift in the curves? And then it's a question of what happens in equilibrium in that market. Let me just show that with the bookmarks. If you do that, and it's down here by the, this one has a bookmark already, so I'd be removing it. But up here, you can have a list of them, right? So I have one right at the end of chapter 4. There's this key diagram, right? And there's one at the end of chapter 3, right, with the labor market, right, as well. And there are similar tables in chapter 3 about what shifts labor demand, labor supply. So it's really important that you understand what those are. You can, again, I just want to point out that you can use these bookmarks to quickly come back to things in the same way you use sticky notes in a hard copy of the book. So make use of all the tools that you have. All right. So once we have this diagram, once we understand what causes causes this to look this way, what causes this curve to look this way, right? Why is it downward sloping with the real interest rate? Why is this one upward sloping with the real interest rate? Understanding that those are decisions by consumers or Congress and the president leading to that one. But really the real interest rate part has to do with consumers making decisions about how much to consume today versus in the future, and therefore how much to save today versus consume. And then this one has to do with profit maximization by firms and how much capital that they want to purchase. And that's dependent on the real interest rate because that affects the user cost of capital. And then to go back into the chapter and really understand that. And then to say, well, what causes shifts in these curves? Because once they shift, that's going to cause a change in the equilibrium real interest rate and the equilibrium level of investment in the economy. And so those are the kinds of questions that you're getting on homework, you're going to see on exams, real world analogs to those things, and how the model that we have can help us understand that, right? And so I really need you to always trust the model. I need you to use the model. I need you to go back to the model and think about things in terms of the model. It's a tool for disciplining your thinking. And then, so it simplifies things, and then we can go back in and add complications and see how that changes the answer. But our starting point has to be, how do things in the real world? How do we model that? How do we show that in these models? Because that really strips away all the complications, keeps us focused on the things that are most important, and then we can add other things back in around that. But we don't want to add everything all at once. That's the power of economics. That's the power of economic models to help us really streamline and discipline our thinking and really get to the heart of what's important and to analyze things and problem solve, right? And that's the translation from here's something I hear in the news, here's something I hear about economic policy, here's what's happening with the government, and how does that, or consumers, how does that influence or the stock market or whatever, how does that influence consumers' behavior? How does that influence firms' behavior? And what impact does that have on the macro economy?